So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome back to another episode of the IRR Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Stewart Heath. Stewart Heath is a passionate entrepreneur and leader with over 35 years of experience transforming organizations into efficient operations with a path to profitability. Heath found interest in his career at an early age, watching his CPA father produce business success for clients. In 1985, Heath graduated from Auburn University with a degree in accounting. Since then, he has held multiple C-level positions. In 2011, Stewart Heath founded Harvard Grace Corporation, where he and his team provided business advisory services, specializing in financial and operational fractional C-level engagements. Heath has been a real estate investor for over 20 years. His experience includes commercial and multifamily development, construction, management, and investing. Heath learned many lessons of the best practices of holding and operating real estate during the financial crisis of the last decade. He now brings his wisdom he gained to the syndicated offerings brought to market by Harvard Grace Capital. Heath is also known for giving back to the community throughout his career. He currently serves on the board of Freedom Business Alliance, an organization focused on stopping human trafficking. Previously, he served on the board for New Hope Academy in Franklin, Tennessee, a school focused on racial reconciliation. In a previous role, he met staff members' needs by providing homework sessions and career guidance to mothers who were working full-time and enrolled in classes to build a better future. Stewart Heath welcomes opportunities to share his story and is always looking for more ways to give back to the community. Okay, so that was a very long-winded intro, but again, very awesome, very accomplished career, and really want to touch on all of it. So let's kind of jump right into the beginning here. I see you've been CFO of a lot of companies. So kind of talk to us about the early years in your career and how that's led you to where we're at now.
Well, great. Thank you for that. I was almost impressed listening to that. And then I realized, oh yeah, I wrote that. Yeah, early in my career, I like a lot of people, didn't know what I wanted to do when I went to college, and figured, knew my dad was a CPA, so I'll major in accounting and take it from there. And I did, graduated from Auburn and got a job with Price Waterhouse straight out of college in Nashville, and sort of in public accounting is a great intro to business if you're really coming from a space of really not knowing what business is and what goes on and how business works. And I did that for 4 years. And naturally, at the bright age of 25, I figured, oh, I got this. And so I started my own firm and had that firm for about 10 years. And I guess it was longer than that. So closer to 15 years, and now that I think about it. Anyway, but it just started a local practice in Franklin, Tennessee, just south of Nashville, and did audits and taxes and some consulting jobs. I really enjoyed those fractional CFO jobs that I would pick up from time to time, but then saw a lot of my clients come along and have success flipping real estate or parlaying generating some great wealth, buying a small apartment buildings, that kind of thing, and had never really considered it real estate. And as I was recalling this the other day, back in the late 80s, early 1990s, real estate had gotten a really bad rap, because I was in college when they passed the first couple of tax acts during Ronald Reagan's first term, and then his second term. I was just out of college, the 1986 Tax Act, which essentially put tax shelter real estate deals out of business. But to a lot of people's minds, real estate became the bad guy. which is kind of silly if you think about it. But banks for a couple of years wouldn't lend a dime on real estate because they had taken a bath on these things. So it was just hard to do until, just say, some sanity came back in the world, because there's a reason it's called real estate. It's because it's real. If the bank needs to take it back, it's there. You can then go take it back if they have to. But I had sort of gotten this mindset that no, real estate is that's risky and dangerous, and it can be, depending on who's doing it and how you're doing it. But anyway, I started to tiptoe in the water and of investing in real estate. And one day I bought a duplex in the hood for on a seller note. I think I paid him $500. And he took back the rest, and I had to refinance him out in 2 years. And so just like that, I was a landlord. And there was already a tenant in one side, and so I had to go find another tenant. Well, that was an exercise in fun. But then I like this. I was building some equity, and then the next deal I did, I'd found another guy he was wanting to sell 14 duplexes, all contiguous to each other at this place up in Nashville. Well, I worked on that deal for about 90 days and finally figured out how to do it without much money in it, and got that. So now I had 30 rental units. 28 in one, and then the first one. So now 30 units. I'm like, wow, I am really something. And from there, I just kept plodding along and buying more here. And then I flipped a house along the way, and didn't really like that. I figured I made about $1 an hour doing that. So, but anyway, I did it, and I got out without any real, without any damage, and started building houses. Then I started doing development and office. And long story short, I had a rental portfolio of about 200 units when 2008 comes along, and I was refining one to buy the next and do this. So the financial crisis come along, and I owed way too much money to be able to withstand, and I needed to keep doing deals to sort of to be able to pay the bills. So I had really, being a CPA, I really hadn't done a very good financial structure, but I had assumed the market would never go down, and it did, and it stalled, and so I got wiped out. But all along the way, I got wiped out. Had to go get a real job, and just basically rebuilt myself. But all along the way, I never really lost my love and interest and conviction that real estate is the way the average person can build wealth in this world and in this country. So I've continued to be involved in real estate. I've been managing it. I've had a few rentals over the last few years, but Harvard Grace Capital, just a little over a month ago, closed its first syndicated real estate deal of an office property in Spring Hill, Tennessee. So we're excited about that, and looking at 2 or 3 others to do this year. So.
Awesome. That was really a great story there. So it sounds like, kind of your classic beginning started with a duplex, sounded like you house hacked it, lived in one side, and then you were able to take on this portfolio, which of course propelled you forward. Sounds like in there as well, you left the W-2 world and were focusing primarily on real estate. And then, like many people, the crash in 2008 led you back to W-2. Did you have to liquidate the entire portfolio? Were you able to hang on to stuff?
I lost it all,
Oh, wow.
except for that original duplex.
Oh, wow. Okay.
And it was on a private mortgage, and he had always gotten paid, and he just said, let's just roll with it. And so that was, and so I did live in that one for a time. And so, but that was actually the capital I used to sort of get back on my feet when I did sell that in 2012. And ultimately, but that was the only piece I was able to hold on to.
Wow. Okay. And were you able to get out without all losses, or did you take a
No,
pretty good
no,
haircut?
I went all the way under. It's I don't mind talking about it now, but just because there's really such a lesson to be learned, frankly. I was doing some financing in June of 2008, and I had to put together a personal financial statement for the lender. And after I had all my partnerships and all my stuff, and so at the end of the day, my net worth based upon appraisals in June of 2008, my net worth was about $10 million.
Oh, wow.
And like, wow, I'm impressed with myself. But that was the election year, and the financial crisis, got going in earnest there that very next month. Countrywide Mortgage said in the last week of July of 2008 that, oh, by the way, we can't fund all those loans that we've made commitments on. And so that was where it really got going, and defaults and everywhere. Earlier that year, Lehman Brothers and Bear Stearns had already collapsed. And I was just rocking along like nothing was happening. And then 90 days later, I was in the thick of it with banks who were closing down lines of credit and wanting to know how are you going to do this? How not advancing anymore on construction lines and things of the like. And I didn't know what I was going to do. I had no options. I figure about 90 days after that financial statement, off of fresh appraisals, I was probably underwater $5 million. And that's how quick property values changed. But the lesson there was, don't be fully leveraged. I didn't keep a lot of cash. I didn't think, what do you need cash for? Debt was cheap at the time. But it was such, because you don't ever know how quickly things are going to turn. And so now I do things quite a bit differently. And so I have learned the hard way, the power of having reserves. And so I did a post-mortem several years later on that, and calculated what I would have needed to survive 2 years after that. It was between $300,000 and $500,000 in cash on a $20 million portfolio with $10 million in equity in it. I mean, that's nothing. And I would probably still have some of those assets today if I had. So that's the lesson, and that's what I would communicate to everybody. It's fun to move fast. It's fun to keep buying and keep rolling it over. And frankly, you can do some of that today, but you're only risking yourself. The banks, I'm not going to say they didn't get hurt, whatnot, but the bailout took care of the banks. It didn't take care of property owners. So.
Totally. Yeah, that's wow, a lot of very valuable lessons there for sure. Okay, so that's very interesting. And as mentioned, kind of in the intro there, that's led to obviously sort of a more rounded and I would say probably more strategic approach here now for Harvard Grace Capital. So kind of talk to me how you're implementing some of those lessons you learned and what your investment thesis is over there at HCC.
So our investment thesis is, first, we focus on the 840-565 corridor, which is my fun way of saying the Tennessee Valley, if you would, so south of Nashville, where I-840 cuts across as a connector. Below that, down through northern Alabama, where I-565 sort of cuts across the northern part of the state, down through Huntsville. We see this as just a major strategic area. We like to take a long time and study our deals. I don't think I'm fast enough to do a deal in Nashville right now, and so that might change one day. Nashville's a hot market. I'm not against market, and I'm not predicting doom, but we analyze our deals to death to try to make sure we're not making mistakes, make sure that we know them very well. So there's less competition out here in the secondary and tertiary markets. That's changing. I blogged about that last week. That's actually changing because there's more capital trying to find more deals. So they're going to the suburbs of the big cities. But there's even opportunities in the smaller rural communities as well. But we're just really high on Huntsville. So one is our target market. We don't just focus on an asset class. We will focus on all commercial asset classes in our geographic area. It's an area that we know very well. So we closed our first syndication. The other tenet of a Harvard Grace deal is that it's going to cash flow from day one. And I'm not saying other people don't. We are concerned over cap rate compression that a lot of people are talking about now. Very concerned about that. And the asset class that you don't see that as much in is in office. Now, this suburban office building that we bought, it's very suburban. There's 200 houses right across the street, but it's 27,000 plus square feet, and it's 100% full. And I actually managed it for a couple of years before we bought it, but so we were very familiar with it. But I mean, it's a cash flowing deal from day one.
Okay.
That's important to us, and that probably limits our targets out there.
Okay. Yeah, that's very interesting and sounds like a little carryover again from kind of what you went through there in the crash. So obviously you're in the suburban office. Sounds like it's already been rented out. You had managed it. So what are you guys seeing in the suburban office space, especially in this area that you're in? You know, was it hit by COVID, or are you able to find, you know, those tenants who stayed through and are still able to, you know, meet their lease on time?
All the tenants that were there in January of 2020 are still here. We had one space open at the time, and we actually leased it during 2020. We were kind of shocked. But office space depends on a lot of what city or state you're in. In the South, pretty much in Tennessee, we've sort of pretended like COVID hadn't been around for a year and a half. But there was already a trend of businesses moving out of the city centers again back to suburban office. And you really just got to know your area. We see a lot of demand on suburban office. If I had another lot around here, I'd probably build another one. I mean, just because of the area that we're in. You know, all real estate is local. I wouldn't buy an office building in California or Chicago right now because you know you still got some restrictions in place there. We haven't had restrictions ever. I won't say never, but not since 90 days after they were put on. So the South has been pretty wide open.
Okay.
Yeah. Yeah. Go ahead.
Oh, no, I was just going to say, I mean, that makes total sense, right? The demographic down there has not really been on the COVID train in terms of the restrictions, which, you know, certainly helps for this asset class and even for the community. I mean,
Sure.
The economy is down there. Like you mentioned, Huntsville is starting to take off. I know even 5 years ago, you rarely heard that city name. And now, you know, you have a lot of operators who are going into that area, and it sounds like it's still relatively affordable, obviously, compared to other markets. I know I was reading on your website, it sounds like it could potentially be the largest city in Alabama here within the next 6 or 8 years. So
yeah, I think it's still on track for that, for sure.
Okay, awesome. And then are you in the multifamily space in this area as well?
We are not yet, although we're very open for it. To me, that's where cap rate compression has hit the most. And that does impact our desire to cash flow in year one. And I talked to a lot of people in the multifamily space, and they said, yeah, but you know, your rents are going to go up 12% that first year. And I'm just not there where I can accept that yet. And I'm not criticizing anybody, but when you're buying a deal on a 3% cap rate and your financing is at 3.5 or 4, I mean, that's just baked in losing money, from year one. So we'll probably wait till that cools off, unless we can find a good value add multifamily deal to do, which we're open to doing, which is a little bit outside of the cash flow regime. But as long as the investors understand, what the plan is. But one of our tenants is stabilized and increasing cash flows.
Okay. Awesome. Yeah. It sounds, again, like you said, because of your, experience and everything you've gone through, I'd really love to get your idea of, you talked about, in a way, you were fully leveraged. Are you starting to see some of the same trends in some of these operators, some of these cities? Kind of talk to me about what you see coming, in the future with inflation being so high and, some of the issues we're facing now.
Yeah, hard to predict. There is going to be a reckoning coming because inflation can't stay this high, and energy as a percent of the average dollar can't stay this high without something giving. Could it be temporary? I don't know. I think that the wage inflation is not temporary. You're not going to hire people at $15 an hour and then get to lower them back to 12. That ain't going to happen. So I think that piece is permanent. Can fuel prices come back down? Yeah, they can. I mean, there was a time in the last 2 years where price per gallon of gas was cheaper than it was when I was in high school. So, I mean, that's a pure commodity and can go up and down, and it's a supply and demand type market. So I don't know that the fuel inflation as a part of the overall inflation is permanent. We heard all last year that the Fed was calling it transitory inflation. I think that's a term they made up during COVID. Nobody'd ever heard of that before. So, but I think what that means is that cap rate compression may slow down and may expand. Interest rates are going up. They've been telling us, well, they might raise them 7 times this year. I mean, so I don't know that that's a big deal, depending on how many times they raise it at each meeting. I mean, hoping they don't raise it a full 100 basis points at each meeting, because that would be crazy. But I've done deals at 7% interest rates, and they can be good. It just changes valuations. So to me, some of the easy credit has given me concern. I haven't seen any operators that I'm all that concerned with. Most of the people I know are my age, and so they've lived through the same stuff that I've lived through, and so they're not going to go too leveraged and too far extended. So I think most of the operators are out there. There's still good deals to be had, but everybody's watching it with a wary eye.
Absolutely. Yeah. Like you mentioned, I mean, there aren't too many operators who, and I really think even lenders are really trying to avoid, over leverage. Nobody wants to go through what we went through. And certainly, like you mentioned, very hard to predict. I certainly think keeping an eye on asset prices in some of these markets is certainly something to keep an eye on, especially for some of the operators taking them on, right now and kind of moving forward over the next probably 12 months, just really keeping an eye. They can only compress so far. You can only add so much value before, we sort of stabilize, and hopefully the Fed's keeping an eye on that as well. I know that they're typically more concerned with the stock market and keeping that stabilized. So now when you guys are going into these, you've been in this market obviously for a long time. Are you using boots on the ground? Is it broker, combination of both, or what are you guys typically using to find your deals?
It is a combination of both. I've recently also gotten a CoStar subscription, which it just allows you to really parse the market down to all kinds of levels. So I've been geeking out over that. But mainly it's brokers or people that the network. I mean, obviously the one we just did was a building I was managing. So they say, hey, let's put it on the market. And I said, well, what if we didn't? And I just brought you an offer. So so that was a deal from the network, but it's all of the above. It's talking to people, talking to brokers, and doing your own searches. Where do you want to be?
Absolutely. And then your network of investors, is this, did you have to introduce a lot of them to the space, or is it just people who've followed you kind of along through your career and you've built up and also were investing, when you started, or, where are you finding most of your investor base?
Most of my investor base came from my network of the last 20 years or so. Most of them had never done an office building deal, much less a real estate deal. So I was very gratified to have a lot of them come along, just because, well, Stewart, we're investing in you. I mean, just very humbling and rewarding. I actually found one investor through just sheer digital marketing down in Birmingham, who was intrigued by our emphasis on the space, on our target market, and he's become a good friend. So we continue to do a lot of digital efforts to get introduced to new people, but most of our investors in this deal were people I've known for 20 years or more.
Awesome. That's awesome. That's a perfect example of know, like, and trust. You've earned that status in their head, and you're able to lead them to a new asset class. And sounds like cash flow from day one is a nice thing to offer, especially brand new investors, for sure.
Yeah.
So we're getting close here, but I definitely want to talk a little bit about some of the things you do, for the community and give back, some of these nonprofits. So talk to me how you found this Freedom Business Alliance and what you guys do over there.
Interesting. And they're working on a problem I didn't even know existed 2 years ago. So I participate in a business event that takes place in Birmingham, Alabama, called the Lion's Den. There's also a companion one in Dallas. Dallas event is in the springtime, and the Birmingham one's in the fall, which is a great time to be in Birmingham. And basically, it's a Christian Shark Tank, if you would. So it's a meeting place, and all days of meetings and different classes. And then the latter half of the day is where entrepreneurs come to get funded, by impact capitalists, if you would, people who are wanting to make a change. And so anyway, when I was in October of 2020, I was at the event, and the executive director of Freedom Business Alliance was there to speak. And I didn't even know there was such a thing. So a freedom business is a business that's been organized anywhere to help combat human trafficking. And I'm just like, really? Is that still a thing? I mean, I just didn't know. And I was, began to get horrified. And so I started talking with Rachel, who's the director, and over the next 8 or 9 months, we continued to talk. And then they asked me to go on the board last summer. So I joined their board. And so we've got freedom business clients, and think of FBA as a trade association on steroids for freedom businesses. And so this was just a perfect way for me to use my CPA and consulting background, because a lot of these guys, they're not even business people. They're just trying to provide jobs to somebody trying to get out of the sex industry in Indonesia or in India or whatever. And they need nuts and bolts kind of help to run a business. And so, I can do that. I might not have any purview to know anything, know how to stop anything in the sex trade, but I can help that business stay in business so they can help more people. So that's one example that I get really excited about, as you can probably tell.
Wow, that's awesome. Yeah, I can tell how passionate you are, and that's an incredible space to be in, because it is, something that's not talked about often, but unfortunately is still very prevalent, especially like you mentioned in some of those smaller Asian countries. Where they have an abundance of people and maybe not the infrastructure to, take care of them like we do, a little more third world. So that's really awesome, and awesome you get to use, your experience to help them get on their feet and, share that knowledge. So I'll kind of jump into the final 5 questions here as we wrap up. What's the best advice you've gotten from a mentor?
When I was early on and before I really got it, I was sort of whining to my mentors. Felt like I was spinning my wheels in my CPA practice, and he asked me some questions, and he said, "Well, you got to get in the game." And he said, you weren't putting any of your time or money into any assets to grow wealth. He said, "You're not even in the game. You've got to get in the game." So, and it changed my thinking. And the other piece of advice he gave me was go read Rich Dad, Poor Dad, which is pretty popular among a lot of real estate guys. Probably one of those most poorly written books in the world, but one of the most effective books, with Kiyosaki's stream of consciousness style, but 199 pages and chock full of great advice. So,
absolutely, that's kind of the Bible, if you will, of real estate investing is Rich Dad, Poor Dad. I think everybody, if you haven't read it, you obviously need to, and certainly, it's hard to find someone who didn't start with that book. Yeah. So awesome. So next one here, at least here in my business, we celebrate our failures, right? I certainly think if you're failing, that means you're trying hard enough, and certainly we like to learn from those. So give me a recent failure, a mistake, and what you learned.
Recent failure. Well, my biggest failure I've already told you about, and feel like I'm still yielding that learning. But recent failures is not embracing sort of the mastermind community up until May of last year. And when I joined Raise Masters, and just frankly just didn't expect a whole lot, and have as Hunter would say, I've gotten a fourfold return on that investment already, and not just the learning, which I haven't even had a chance to apply it all yet. So just should have just embraced community and consulting and coaching much earlier in my career. So.
Yeah, that's certainly something, Raise Masters was also my first mastermind as well. And, I went into it almost in the same headspace as you, and wow, what a difference. Just, I joined in September of last year, and it's propelled my career. I mean, more in the last 6 months than I probably did in the previous 12 months. Yeah. So
even if just from the monthly meetings, you see all these people who are doing what we're doing, it just gives you confidence.
Yep, it really does. Awesome. So what's your favorite non-real estate or investment related book?
Non-real estate and non-investment related book. I would call it, this might be business related, the faith-driven entrepreneur. Okay. So the role of business in society. As sort of a mission field of itself. So
awesome. And then are you familiar with Marvel, like the Marvel superheroes?
Sure.
Awesome. If your personal investor avatar was a Marvel superhero, which one would it be?
Oh, that's a tough one. My wife would probably say Doctor Strange.
Okay. So, I've heard that one yet. I like it.
Yeah, I love Iron Man. So he's Tony Stark is kind of my favorite. So, but I don't know if that's more who I want to be, or if that's who I'm really like. So I'd have to ponder that one some more.
Awesome. I love it. Cool. Well, let's wrap it up here. What's the best way for people to get a hold of you and reach out to learn more about you?
Yeah, great. If you go to harvardgracecapital.com, you will find ways to connect with me and my Calendly link, which I would love for anybody to reach out and let's just grab some time and chat. You can shoot me an email from there, and we can go from there. Or LinkedIn. I'm at Stewart Heath, based in Spring Hill, Tennessee. There is another Stewart Heath, which I finally found, and he's in in Singapore. So no relation. But,
okay, good to know. And we will link all of that in the show notes. Stewart, it's been incredible talking to you. I've really, really enjoyed it, and wish you luck continuing on. Thanks for coming on.
Thank you, Jonathan. Thank you so much for having me. Really appreciate it.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.